Hi Mortgage Heroes, Andy Cruz here in Business Development, and this is Monday Mortgage Minute. Welcome back to a new week. We have a jam-packed session we got to get to right away, so I'm going to jump right in and we're going to talk about the Fed's comments last week coming out of their two-day meeting. And the big news was that they said they are going to end tapering by mid-2022. Now, they did not give any tip as to when they're going to start tapering, but the simple fact that they kind of have an end destination in mind gives everyone the sense that it's going to happen soon. Now, the trouble with this, of course, is that we've been discussing that when the Fed passes back full responsibility to the market's going to start pricing that in. And we saw that as quick as Thursday and Friday of last week. Jerome Powell made his comments on Wednesday, and by Friday, we had a huge spike in mortgage rates where they went up as much as 70 basis points during the trading session, finally came back down and settled around 30 points for the week. But that still translates into an 1/8 to 1/4% of a higher rate to the consumer once passed on. And we're just getting started. That's the part that is really concerning people, is that even though they haven't stated when they're going to start doing the tapering, the idea that tapering is around the corner is already being priced into the market and becoming an impact on fixed rate mortgages. This is why the sense of urgency we've had for several weeks now saying, get your refinance done, get your application started, especially coming into the winter months and going into the brand new year. Now that they have a window that they want mid-2022 to be the end of the tapering, this is the time. I'm emphasizing this with great urgency because we have also the highest home equity values we've had in recent history happening right now. The artificially low interest rates, which cause prices to soar or assisted prices soaring over the last 18 months, means that most of you watching this have more equity in your home right now than you have ever had during your home ownership, even if you've owned the house for only 12 months, and especially if you've owned the house more than just a year or two. It is very likely you have more equity now than you've ever had. That means two things. You can do the Cash Out Refinance right now to save for a rainy day, do those home upgrades, remodel, pay off consumer debt, whatever that might look like. Or you can do the Rate Term Refinance, which will simply help save on your monthly expense by reducing the cost while the interest rate market is still low. Right now, there is no evidence in the marketplace that we're going to see another dip in the markets. Is it possible that it could happen at some point because of some black swan event or some unforeseen circumstance or variable in the market? Yeah, absolutely. That's always on the table. But right now, all the things we do know are leading towards higher rates ahead. Now, the other thing I want to make sure I'm addressing here today is that we talk about the Fed talking out of both sides of their mouth. On one hand, they're saying, and have said for many meetings now, oh, well, the inflation is transitory. The inflation is transitory. Except then last week, they just kind of admitted that the inflation is actually higher than they were intending to. It is far shot beyond the 2% inflation rate they want. And now you even have Fed members disagreeing on what's actually happening. At the same time, you have the Fed coming out with a statement saying that inflation is running hotter than they want. You have Fed members actually saying that the inflation is cooling off. Well, what data are they looking at that says that? Because you can't say that inflation is hotter than you were expecting. At the same time, Fed members saying it's cooling off, and that the tapering and you stepping out of your participation in buying bonds is going to make that any better. Those actually functionally don't go together. So there's definitely disagreement happening behind closed doors when publicly they're talking about two different things that actually are in diametric conflict with one another. So this is very interesting to me because it gives a sense that there is some disagreement, number one. Number two, the fact that they're kind of audibly saying these things out to the public is very telling that they're not on the same page. And that is unfortunate because that could mean that there's going to be some struggle session coming into quarter four, coming into quarter one of the brand new year on what Fed policy might mean, what we'll see for short-term interest rates, and then what that's all going to do economically, considering all the variables we've been talking about: unemployment, affordability issues, inflation to the consumer at the checkout line when they're at the grocery store, us seeing consumer goods and prices go higher and higher and higher over the last year. So, you can't run forever and say things are a certain way when the eyes of the consumer are literally seeing it the opposite way. And I think that that's potentially going to be certainly going to be a talking point problem from the Fed and their credibility, but also from the perspective of trying to predict what is going to happen next and how they're going to make it happen. I think that they are making it very difficult on themselves to get people on board behind their plans, especially the timing of it when they're literally battling about what the evidence is showing and what their perspective is saying. Like always, please share this video with someone you know that could help, that could be helped by this information, that could have a little bit of additional knowledge, and they're looking to make the next right choice in real estate and mortgage. Please ask us questions, make a comment below, send a direct message or an email so we can help you get started. It is really important that in these coming months you make the right choices now, because all indicators lead towards higher rates, and we want you to make sure that you're saving as much money as you can or getting yourself prepared so that you're not looking at this in hindsight going, I woulda, coulda, shoulda. Thank you so much for watching, and we'll see you again next week.